Raising Money for a Startup, presented by WallStreetSurvivor.com. Here's Richard. Richard came up with a brilliant idea. He can compress videos at a much higher rate than any other company on the market. But you can't just sell an idea, you have to build a business around it. Which means Richard needs to hire employees, rent an office space, and start marketing his idea. All of this takes money, and usually the more money you have, the faster you can grow the company. Now Richard has a few options. Richard can bootstrap his business, meaning he doesn't take on outside money, but rather reinvests the company's profits to grow the business. There are a few advantages and disadvantages to bootstrapping. By not taking on investors, Richard can keep complete control of his company and doesn't have to share any of the profits in the event that he can sell. By the same token, because the company doesn't have a lot of extra money, they'll have to grow a little slower by hiring less workers, be more frugal on acquiring new customers, and maybe staying in the garage a little longer. Richard can also borrow money from the bank. A bank charges interest on the borrowed money. Let's say the bank charges 5% a month in interest, and Richard needs $1 million to build his business. Every month, Richard needs to pay back $50,000 until the loan is paid back. What's more common these days to start a business is to take on investors, which usually come in two forms: angel investors and venture capitalists. But both invest in your company by giving you capital in exchange for a portion of your equity. How much an investor takes in equity depends on the valuation of your business. For example, Richard needs that $1 million to move forward. He and his investors agree that the business is worth $4 million pre-money, meaning not including the invested cash. In that case, the investors would take 25% of the company pre-money or 20% of the company post-money. An angel usually invests earlier in the process than a VC, when the business is nothing more than an idea. An angel can often be a friend, or family member, or someone in the community looking to invest in a great idea. A VC typically invests a little later, when the business has some traction, meaning revenue or customers, and a solid business model. To learn more about raising money for a startup, check out courses at WallStreetSurvivor.com.